Seriously, what a heck of a day. We had the market opening all like we had an emotional ecstasy attack going on. Everyone was thinking that just because the budget was passed, all things in the market are going to be wonderful now. And apparently, the market was already expecting it. So we started out with over 1% up in all of the major indices, and we got as far as 1.25% down, and we finished on average between the indices. Let's see, S&P 500 0.4% down, Nasdaq Composite about a little over 0.4%, and the Dow Jones Industrial Average just breaking even. Anyway, what a heck of a day. So, what is going to happen next? I'm still not making stock picks right now because I want to see a definitive downward breakout. I'm just saying, I am still bearish. Once again, today, high volume, high selling volume. The relief rally was a short squeeze. It was short-lived. Our target in the S&P 500 from this descending triangle is 124 and 50 cents in the SPY ETF, corresponding to 1245 in the S&P 500. I'm analyzing the ETFs. The patterns in this one look a little cleaner than the index. So what happened today? We're going to zoom in just to the 1 month chart. This right here is a classical bearish engulfing pattern. We had 2 days, very wide ranges. The first one was wide, the second was even wider, and this is traditionally a short-term candlestick pattern that can either be a bearish reversal or a bearish continuation. Now, according to the studies by Thomas Bulkowski, these patterns will predict a bearish reversal 79% of the time. In addition, the percentage of these patterns meeting their price target is 76%. Now, measuring the price target, it's a little different for candle pattern. Unfortunately, I can't find from his studies that the exact method of projecting the price target, but I'm just going to assume on this one that you take the height of the pattern, project it beneath the close of that day. That will give us a conservative estimate. That gives us a target of 1255 in the S&P 500, or perhaps if his actual method was to measure from the bottom of the pattern, that would give us a target, once again, 1240, 1245 in the S&P 500. Like I said, meets the price target 76% of the time. On average, after this pattern is broken, the average decline within the next 10 days is 5.92%. So a fast market. Then it often reverses. He ranked this number 5 out of the 103 candlestick patterns that he tested. Needless to say, I'm still bearish. Okay, now I wanted to also take a look at my divergence sets just to see if we have any more hints about this market. I'll get rid of the volume pane. We still have a stochastic sell. This triangle formation in the RSI has completely broken down, and the momentum looks like it's reversing a tiny bit. Still, we're bearish. Absolutely. We're looking for a key level to be broken. Now, we broke through the 200-day moving average today briefly, but what we're especially looking for is a break below 12's, let's see, it will be 1265 in the S&P 500. That's going to constitute a breakout of the symmetrical triangle. We have preliminary targets of 124.50, and then our long-term target will be from the point of the breakout, which I believe will happen next week. Go back to the old chart. Our target would then be the lows of November of 2010 at 1170, 1165 in the S&P 500, a 10% decline from where it is now. Alright, just letting you know, I'm still bearish. Hold your positions.